Welcome to episode 70 of the Ontario Mortgage and Real Estate Insights podcast. I'm your host, Steve Hamelin. Today, we've got a lot to cover, so let's dive right in. Our first topic is the significant drop in existing home and condo sales as buyers wait for more rate cuts. The Bank of Canada's recent rate cut was expected to boost the housing market, but the country's largest real estate board said existing home and condominium sales activity remains mostly on hold as buyers wait for more reductions. The Greater Toronto Area saw 6,213 home sales in its systems in June, a 16.4% drop compared to 7,429 sales reported in June 2023, according to the Toronto Regional Real Estate Board, also known as TREB. New listings rose to 17,964, a year-over-year increase of 12.3%. The average selling price of $1,162,167 was down by 1.6% from a year ago, according to the TREB. The Toronto Regional Real Estate Board said the central bank must repeat its June decision to cut its overnight lending rate. In fact, the board said that several reductions probably will be needed before sales volume rebounds. Jennifer Pierce, president of TRREB, said in a statement, "The Bank of Canada's rate cut last month provided some initial relief for homeowners and home buyers. However, the June sales results suggest that most home buyers will require multiple rate cuts before they move off the sidelines." Once home sales in Greater Toronto gain momentum, an ample number of homes on the market should ensure pricing doesn't jump, the board said. Jason Mercer, chief market analyst with the board, mentioned in a commentary, "The GTA housing market is currently well supplied. Recent home buyers have benefited from substantial choice and therefore negotiating power on price. Moving forward, as sales pick up alongside lower borrowing costs, elevated inventory levels will help mitigate against a quick run-up in selling prices." Turning our focus to Calgary, the city also saw a significant drop in home sales in June. Sales tumbled 12.8% from the same month in 2023, while new listings decreased by 3.6% and inventory rose by 9.2%, according to new numbers from the Calgary Real Estate Board. Condo sales in Calgary were down 8% for June, as properties priced under $300,000 were scarce. The board blamed a shortage of affordable homes across all residential property types. Anne-Marie Lurie, the organization's chief economist, said in a statement, "The pullback in sales reflects supply challenges in the lower price ranges, ultimately limiting sales activity." Despite the decline, 40% of the homes sold in Calgary went for over the asking price, and the unadjusted benchmark home price rose 9% over last June to $608,000, according to the board. The biggest increases were seen in the northeast and east sections of Calgary. The numbers come in the midst of a population surge in Alberta's biggest city. Calgary's 5.9% population growth between 2022 and 2023 was the highest of any of Canada's 6 metropolitan areas, with a population of over 1 million, according to recent Statistics Canada data. However, its 8.1% unemployment rate remains one of Canada's highest, although it is partly explained by the 73% labour participation rate, which is Canada's highest. In Canada's most expensive city for housing, the Greater Vancouver Realtors said the area has become a buyer's market with inventory continuing to accumulate to levels not seen since the spring of 2019. The organization said this week June sales in the region were 2,018, a 19.1% decrease from the 2,088 sales recorded a year earlier. The sales numbers were 23.6% below the 10-year seasonal average. Andrew Liss, Director of Economics and Data Analytics for the Greater Vancouver Realtors, said in a commentary, "The June data continued a trend we've been watching where buyers appear hesitant to transact in volumes we consider typical for this time of year, while sellers remain keen to bring their properties to market. This dynamic is bringing inventory levels up to a healthy range not seen since before the pandemic. This trend is providing buyers more selection to choose from and driving all market segments toward balanced conditions." Like Toronto Realtors, Vancouver agents are hopeful the Bank of Canada cuts its interest rate again. The central bank is set to release its next announcement on July 24th. Andrew Liss said about a potential rate cut, "This is yet another factor tilting the market in favor of buyers, even if the boost to affordability is modest. But June's lower-than-normal transaction volumes suggest many buyers remain hesitant, which has allowed inventory to accumulate and has kept a lid on upward price pressure across market segments. The group's composite benchmark price for all residential properties in Metro Vancouver is currently $1,270,100, a 0.5% increase from a year ago and a 0.4% decrease compared to May 2024. Montreal, Canada's second-largest city, proved to be a bright spot in June when the greater metropolitan area saw a 6.4% increase in residential sales in the greater metropolitan area over the same month last year, according to the Quebec Professional Association of Real Estate Brokers. Meanwhile, the Royal Bank of Canada issued a report Thursday that suggested housing has a long way to reach affordability, but is headed in the right direction, with rate cuts driving that movement. The bank said in a commentary, "We think ownership costs have room to fall further in the period ahead." In June, the Bank of Canada initiated what we expect will amount to a full 2 percentage point cut in its policy rate to 3% by the end of 2025, which will bring down long-term rates as well, but to a lesser extent. Could the Bank of Canada's focus on shelter inflation backfire? That's the question being raised by Bank of Montreal economist Robert Kavchich. He argues that the central bank should avoid placing too much emphasis on rising shelter inflation when making future interest rate decisions. According to Kavchich, this could lead to a scenario where the Bank of Canada cuts rates too little and too late. In an emailed statement to Yahoo Finance Canada, Kavchich said, "The central bank shouldn't get hung up on shelter inflation." He explained that rent and mortgage costs are slow to show up in inflation data, which could skew the Bank of Canada's view of inflation. As a result, the central bank might end up cutting rates too little, too late. Shelter inflation is a significant component of the Consumer Price Index, accounting for roughly a quarter of Canadian spending. Bank of Canada. Governor Tiff Macklem acknowledged the difficulty of lowering inflation to the bank's target of 2%, when a quarter of the inflation basket is driven by shelter costs. Shelter price inflation is still too high and remains the biggest contributor to overall inflation, despite some early signs of easing, Macklem said during the Bank of Canada's recent announcement of its third consecutive rate cut. However, Kavchich pointed out that changes in shelter costs are slow to be reflected in the Consumer Price Index data. He noted that, excluding shelter, the Consumer Price Index has grown at less than 2% year over year for the past 7 months. This slow reflection could skew the Bank of Canada's view, leading to potentially flawed decisions. Many Canadians are already experiencing significant mortgage payment increases as they renew loans at higher rates than during the pandemic. These rising mortgage costs are contributing to higher Consumer Price Index figures, but Kavchich emphasized that the broader housing market is starting to stabilize. Mortgage costs for new buyers are decreasing due to falling interest rates, and market rent has stabilized even before population growth cooled and with more completions in the pipeline, Kavchich said. Additionally, the housing resale market hasn't responded to rate cuts in any concerning way. It hasn't really responded at all yet, he added. This suggests that the Bank of Canada's rate cuts have not yet had a significant impact on the housing market. Bank of Canada Governor Tiff Macklem made a similar point during the rate cut announcement. With mortgage rates coming down, hopefully with more supply coming into the rental market, with some reduction in population growth, you should see rent prices come down, he said. It's going to take more time, he added, highlighting the gradual nature of these changes. While lower mortgage rates could eventually improve affordability, experts suggest it will take time for rate cuts to make a meaningful impact on the housing market. In Toronto, housing market conditions softened in August, with listings to sales ratios hitting their loosest levels since 2008, excluding the COVID-19 period, according to National Bank economist Darren King. Similarly, home sales in Vancouver dropped 17.1% from the previous year, based on data from Greater Vancouver Realtors. This decline indicates that the housing market is still adjusting and that the effects of rate cuts will not be immediate. Victor Tran, a mortgage expert from Rates.ca, told Yahoo Finance Canada, Even a drop of a full percentage point from current mortgage rates would not result in a significant increase in buying power given persistently high home prices. John Lusink, president of Right at Home Realty, echoed this sentiment, stating that the housing market is unlikely to see significant changes until at least 2 more rate cuts are implemented. Ask any lender in Canada about the key reasons behind their success, and there's a very good chance relationships with mortgage brokers will feature at or near the top. The leading lenders across the country know that productive, effective partnerships with brokers are an essential way of keeping business coming in. And Canadian Mortgage Professional is proud to once again reveal the lenders with the best reputation in the eyes of Canada's mortgage broker community. Our Brokers on Lenders 2024 report saw brokers give their verdict on the service provided by lenders across multiple categories, ranking lenders on how they performed in categories including broker support, turnaround time, overall service levels, and commission transparency. The results of that report, which saw Ginkgo Mike among the winners as the top alternative lender in brokers' eyes for 2024, are now available to view for free. Canadian Mortgage Professional contacted brokers around the country, asking them to rate the lenders they work with across 10 key areas. As in previous years, we also asked brokers to weigh in on important aspects of the broker-lender relationship, such as how commissions and bonuses might change, and why they chose to send deals to banks rather than monoline lenders. Lenders were ranked for each category in order of merit, according to an average score calculated from the ratings they received from brokers, with the top 3 lenders and alternative lenders in each category receiving a gold, silver, or bronze medal. Lenders' combined average score from all categories determined the overall gold, silver, and bronze medalists. To read the full report on how Canada's broker community rates the lenders it works with, check out the Brokers on Lenders report now, for free. A new report by Desjardins warns that Ottawa's efforts to kickstart new housing supply likely won't be enough to meet its optimistic targets due to regulatory hurdles and constraints on labor, materials, and financing. The report, released Tuesday by economists Marc Desormeaux, Carrie Norman, and Randall Bartlett, highlighted the ongoing labor shortage in the construction industry as the primary constraint holding back new housing starts. The federal government laid out its Canada Housing Plan earlier this year, vowing to unlock 3.87 million new homes by 2031 through measures such as new tax incentives and efforts to build more housing on public lands. The report noted that 1.87 million of those homes were expected to be built anyway by 2031. It said the federal housing plan could translate into nearly 70,000 additional housing starts in 2028, on top of the roughly 235,000 projected to be built in the absence of those measures. Even with the increase, those figures still come well short of the pace needed to achieve the Canada Mortgage and Housing Corporation's estimated targets to restore affordability by 2030. The Canada Mortgage and Housing Corporation has said the country would need to boost home construction by 3.5 million units, bringing the total number of new homes built within that timeframe to 5.8 million. At the end of the day, building 5.8 million new homes in the next 8 years would be an ambitious plan even if all the stars aligned, the authors wrote, adding it took 3 decades to build the last 5.8 million homes in Canada. With significant labor, materials, financing, and regulatory constraints, the stars aren't currently aligned in Canada. The Canadian Home Builders Association estimates Canada needs more than 1 million additional residential construction workers to meet the Canada Mortgage and Housing Corporation's target. Amid slower population growth and an immigration system that is not focused on attracting skilled tradespeople, an even greater share of domestic resources will need to be dedicated to residential investment to meet federal housing targets, it said. Elevated interest rates and inflation have also increased the cost to finance construction projects, as have regulations such as those requiring builders to use more costly climate-resistant building materials due to extreme weather. That said, simply because Canada is highly unlikely to meet that lofty goal doesn't mean it should throw in the towel, the authors wrote. Even if it can't meet affordability as defined by the Canada Mortgage and Housing Corporation by decade end, the housing supply crisis can still be lessened through building as many homes as possible. Now let's shift gears to some exciting news in the mortgage brokerage world. TMG. The Mortgage Group, one of Canada's largest mortgage brokerages, has announced a strategic partnership with Ontario-based Mortgage Outlet. This collaboration aims to enhance services for each brokerage's respective brokers and improve value for consumers across the country. Sean Stillman, principal broker of Mortgage Outlet, expressed his enthusiasm about the partnership, stating, "This partnership allows our firm to leverage the systems, tools, lender relations, and compliance expertise developed by TMG." He emphasized that both brokerages will maintain their individual brands while working together to drive innovation and develop better tools for brokers. Stillman added, "This partnership, with a continued focus on standards and efficiencies, has been made possible because both organizations share similar visions, founded in the belief that mortgage brokers are ideally suited to meet the needs of Canadian mortgage consumers." TMG, which has been in operation for over 30 years, is a leading independent mortgage brokerage with over 1,400 professionals across the country. The company is recognized for its strong relationships with lenders and its focus on providing top-tier support to its brokers. TMG has been the recipient of the National Full-Service Mortgage Brokerage of the Year Award in 2020, 2021, and 2022. Meanwhile, Mortgage Outlet boasts over 200 agents and $1 billion in annual origination volume. Mark Kersner, CEO of TMG The Mortgage Group, said, "We are extremely excited about this partnership given our values align with our mission to bring service excellence to our brokers. This partnership is expected to bring significant benefits to both brokerages by combining their strengths and resources. By leveraging TMG's systems and tools and Mortgage Outlet's innovative approach, the collaboration aims to provide enhanced support and value to brokers and consumers alike." That's all for today's episode. Thanks for tuning in to episode 70 of the Ontario Mortgage and Real Estate Insights podcast. I'm your host, Steve Hamoan. Stay informed, stay ahead, and we'll catch you next time.